The Wall Street crash of 1929 caused the Great Depression, a severe economic downturn in the US. Many speculate on the potential impact of avoiding the crash and the alternative economic trajectory. The impact of averted crash on the economy. If the Wall Street crash of 1929 had been avoided, the US economy would have likely continued to experience the prosperity of the 1920s. The stock market would have remained stable, and the speculative bubble that led to the crash would not have burst. This means that businesses and individuals would not have lost their investments, and consumer confidence would have remained high. The economy would have continued to grow at a steady pace, and the unemployment rate would have remained low. The prosperity of the 1920s, characterized by new technologies such as automobiles, radios, and household appliances, rising wages due to increased productivity, and widespread consumer adoption of these new products, would have continued into the 1930s. This sustained economic growth would have likely led to further innovation and investment, potentially altering the course of history for the United States and the world economy. Global impact of averted crash. The avoidance of the Wall Street crash in 1929 would have had a far-reaching impact on the global economy. Without the sudden collapse of the US stock market, the chain reaction that transmitted the Great Depression to other nations would have been averted. International trade and investment would have continued to flourish, preventing many countries from enduring the severe economic distress that ensued after the crash. The absence of a global depression would have likely resulted in greater geopolitical stability and potentially reshaped the course of history, especially in Europe and Asia. Countries would not have faced the challenges of widespread unemployment, reduced industrial production, and deflation. The resilience of the global economy, combined with sustained growth and stability, would have likely led to increased investor confidence and further technological advancements. This scenario could have potentially altered the balance of power and international relations, influencing the path of events leading up to World War II. Public policies and financial regulations. If the Wall Street crash of 1929 had been avoided, it would have had a significant impact on public policies and financial regulations. The crash served as a catalyst for policymakers to rethink the necessity of robust financial regulations and mechanisms to prevent future crises. The sense of urgency to implement substantial changes might have been less pressing if the crash had been averted. Consequently, this could have influenced the development of crucial institutions such as the Securities and Exchange Commission, SEC, and the Federal Deposit Insurance Corporation, FDIC, both of which were established in response to the crash as part of the New Deal reforms. The absence of these regulatory bodies could have had long-term implications for the stability and security of the financial system in the United States, potentially leading to a different approach to overseeing financial markets and protecting investors. This altered trajectory of financial regulations would have shaped the governance and oversight of financial institutions, influencing the practices and standards that guide the financial sector to this day. Conclusion. In conclusion, if the Wall Street crash of 1929 had been avoided, the US and global economies would have likely avoided the devastating consequences of the Great Depression. The prosperity of the 1920s could have continued, enabling ongoing technological advancements and rising wages due to increased productivity. The sustained economic growth would have likely led to further innovation and investment, potentially altering the course of history for the United States and the world economy. In addition, the absence of the crash would have influenced public policies and financial regulations in a different way. The urgent need for substantial changes in regulatory frameworks might have been less pressing if the crash had been averted, potentially leading to the development of different institutions and mechanisms to oversee financial markets and protect investors. Understanding the potential impact of avoiding the Wall Street crash provides valuable insights into the interconnectedness of historical events and their lasting effects, shedding light on how pivotal moments in history can have far-reaching consequences that shape the trajectory of economies and public policies.